and then we close half of the homework. Then the rest of that, you can do that too. So far, I leave all the open to the end. So that means deadline is not important. Remember, again, homework is for your practice. So as long as you do practice, then good for your exam, that'd be fine. So if you guys wanted to deadline to close by midterm, like after midterm next day, I will do that. Okay, otherwise just open it. It's not a big deal. And so that's a good question. Okay, I'm not doing like a chapter by chapter. So this homework, you gotta close it. I'm not doing that. Okay, I treat you like, my colleagues. That's you manage your own time, do your own way. You can do one day all the homework done, or you do, step by step, organize your timing, organize your style of the study. Okay, you do your own way. So I open it. Okay, so I will maybe like right now, like I say, it's maybe open until to midterm. So when we finish chapter 7, and then we have the review, then we have the exam. The next day I will close. Could be, or maybe still open, not big deal. Okay, it's a good question. So far you see it will be open. All right.
Okay, thank you.
You're welcome. Any other question?
Professor,
Yes.
I went to buy the book today with in my Pearson, and it's access code, and then e-text is $99, like $100. I see another option which is $70, and it says new design. I really don't know which one to buy.
I think what I guessing is 99. That one is ebook with the homework, and 69.99. That one I think only homework. I guessing. Okay, you can verify. But the good question is to verify with the system. Call them, make sure. And also, I think you ask your classmate. They do. I think somebody maybe can find out those PDF file book regarding to this international version, whatever, maybe free. Somebody did before, but now maybe system doing well. They can control very well. So if you don't have this free ebook, then you just buy homework. I think maybe 69. Okay, that's maybe the reason. So you can verify with them to make sure it's that case.
Oh, okay. Thank you so much, Professor.
You're welcome. Okay. So last time we talked about stock market, we did mention this already. Okay, this, right. And then we talk about financial crisis. I think you never been through like 2008, you're too young to remember maybe. But like we mentioned, the financial crisis is, financial system be interrupted. For example, banking do not lending you money anymore. Like you maybe borrow the student loan and go to college, you cannot borrow money. Then you cannot go to college. People do the small business like open restaurant. People wanted to, do the, like open other business, cannot borrow money to do business. Okay. And that's the problem. That's interruption. So if nobody can get the money from banking, then be trouble. So that's what the financial crisis is, interruption for normal business. Not only that, also you cannot get job, okay? So maybe, this PDF of things, maybe the book, maybe not everybody can get it because that's the past. In the past, international, somebody get the version, whatever can do. Maybe right now the system, like I say, people know how to protect the hacking, whatever. So maybe right now cannot. So if it cannot, then means just, online, the book, ebook or whatever, so $99, okay? So you guys figure out yourself. Okay, so that's the financial crisis, all right? So why study money, banking, monetary policy? So we mentioned about the last time I said, why you guys want to take this course, and you didn't mention about it. It is important. It's not just a course, it's like a very, science, physics, mathematics, very theoretical or very, what do I see? It's like go to high level. This actually basically is knowledge. It is for you benefit from this market, from those information, how to handle my own financial situation, my business, my account, and my checking. So those kind of things happen for, okay, when should I buy a house? Should I buy a house now? Should I borrow a loan now? Inflation is coming. It's this kind of thing is not that one day you can learn something. It is knowledge. That's why I say is you should read a newspaper, build up those knowledge. It's helpful. It's helpful for you, for your family member. Okay, so it's important. So that here trying to tell you is money is play very important role in the financial system. Okay, you do know that. Even right now, why we say we'll give you $1,400 to make the economy going recover back to a normal life. So obviously, 2008 financial crisis will also print a lot of money. Okay, so that means really money, it is the key, right? Trying to be help us out of this kind of miserable. So money is one piece of the solution. So that's why we have to learn this important thing. The money play the role, how they did it. Okay, if we do not do quickly, you heard about the chairman of the Treasury. She say, yelling. She say we have to do big and quick. This we learn from the financial crisis, okay? During the financial crisis, 2008, we need to get out. So that's why we feel we slow. If you slow, will be more people lose job, more people have the, losing house, and then be worse and worse compounding. So that's not a good thing. So that's why you do quick and big and then everybody out. Then we're starting to produce better GDP and generate the revenue and everybody getting better. That's what we want to do. But right now we already shut down 1 year. So that means we already, no matter what, how big, how quick, already slow. So that's the only thing is this bug is not you and me, we can control. So that's another thing we needed to know. Money, it is important to play the role, very important role, okay, to help us out of recession. Okay, we are in recession, I mentioned last time, okay? So what do you mean recession? So once recession comes, you can see here, tell you unemployment, right? So most people don't have job. This time I have to mention to you because when you hear about the job report last week, okay, many people lose job, but however, unemployment going down means before 6.7% employment rate, but now it's 6.3%. So why? We lose more job, but the unemployment rate actually is lower. I want to hear from you, see how you get it. Do you know what I mean? Let me mention one more time, okay? We all know right now it's miserable. Right now, it's a lot of people lose job. Millions of people don't have a job right now. Okay, so the last report of the unemployment rate is 6.7%. All right, so this last Friday mentioned about the unemployment actually is going down to 6.3%. So unemployment is lower. Do you know why? Anybody can interpret it a little bit? Okay, close. You go to yes, let somebody help you. You very good point there. Okay, let's see how to interpret this one. And he mentioned about participation. Okay, that's participation rate, very important. Okay, so that's the whole point, misleading you. You will feel confused. Okay, so past, before 6.7%. You saw my screen, right? So right now it is 6.3%. All right. You learn Econ 101, 102, they tell you unemployment, the macroeconomy tell you, okay? So in this unemployment recalculation in there, you have a participation rate, okay? Means how many people participated. So if before hypothetical, before let's say, I'm just hypothetical because this number easy, maybe I don't. Okay, let's say 65% people of the people participated, okay? So if this participating rate dropped lower, let's say 60%, hypothetical, okay? So less people looking for a job. So there, if less in the pool, like he said, it's the calculation is the number changes due to the formula, right? So, okay, so if the pool, the denominator number lower, so of course this number will be lower. The percentage of employment lower because the people looking for job, that number lower. But people looking for job, those people is lower number now. Is it because they get a job? Or is it because they don't looking for a job anymore? Anybody? What do you think?
Probably a bit of both.
Exactly. Don't looking for a job anymore because why? You tell me don't have a job. I'm looking at no job, what I'm looking for. So a lot of people don't looking for a job. But once you don't looking for a job, you will be counted as not participated. So then the pool of the number not participated number lower. So therefore, the employment rate is lower, looking good. So therefore, never trust one number. If you only based on say, oh, economy is so good, employment rate is lower than before. Not so fast. Looking at it deeply, looking at this number, there's a participation. A lot of people closing to retirement age now don't have a job, and then they just say, you know what, I'm just retired. So some people just say, you know what, I'm not looking. That's the problem, okay? So actually, in fact, showing you if it's participation rate lower, that means no people are looking for a job. This means economy is not rosy. Economy may be not good. If we really know a lot of people don't have a job, don't have money, and don't even looking for a job, how could that be good? That won't be good. If everybody have a job, they want looking for a job, they can get one. That's called full employment. Remember in the economy, in the macro. So we are not there. So not looking good. So this is one number didn't show you anything good. Actually, you have to deeper in and see why it's like that. Okay. So unemployment is very important. It's always linked to recession. Once recession, employment is very high. So now we have to see when we still right now in recession, we want to see when we're going to get out. So if this number really showing you, if participation rate stays same, and the unemployment rate is lower, that means we're really getting better. And your stock will going up too, okay? So we'll talk about that more, but at least you know how that works, okay? So expansion, we mentioned about that. If you have recession, you always have expansion. Means after recession get out, it's expansion, okay? Means the business is booming, you get a job, you get a high paid job, those kind of thing, okay? Always have cycle. Here trying to tell you we have cycle, okay? We'll talk more about that. We've touched this already, okay? So we mentioned about the same monetary theory. Remember I mentioned last time, I say, government, the Fed trying to put money in the economic system. That we call money supply. So they base on a lot of armies of PhD graduate student, economics graduate, okay? They do research. They do a lot of the money supply research, monetary theory, and they make decisions about how much money should put in economic system, okay? You can see now people worry about the inflation because remember we just right now just say each person if you give $1,400, then people worry, say, okay, it is too much money already. People already use money gambling on the stock, and we still give. You can see right now a lot of economists are fighting on this $1.9 trillion. Should we give? We haven't given them yet. They're already gambling on GameStop, right? Already gambling on the stock market. So people worry. But then you don't give it, you have a lot of people don't have food to eat, don't have, don't have job, cannot pay rent. You don't want them miserable. So then you will worry about say, how are we gonna do it? Give or not give, that's what they're fighting, okay? So, but both sides have reason, right? The other side say give too much, you will have trouble because they worry. Remember I mentioned last time, I say the inflation will come in, price level will going up. And then because there's too much money in there, money is so cheap, so it's becoming useless, right? So that's what the inflation gonna come in. But meanwhile, you have people still suffering. So that's what we mentioned last time, okay? So let me jump back all the way to last time we've been there. That's what it says. The bar is recession, okay? And the blue line is money change each time. Mean growth rate, you know that, right? So percentage change. If going up 5%, means compared before, increase 5%. If down, then down how many percent? So that's what I do, okay? Now I mentioned that I said money two, it just is measure about compare money one, money two, money three, means add on more unliquid assets. For example, money one, cash, okay? Cash plus something. We'll talk about this. You're gonna have it, okay? Don't worry about it. This is introduction. Introduction just give you some little flavor. Then we go to deeper, okay? So money two, just add on some less liquid assets, and then with the previous money one cash, then becoming money two, and bigger like that. So here measure when they download the data, they build up this chart, is use the money two data, okay? So here trying to show you, remember I said, oh, we learn how to make a summary. All right, I want to make a summary here, and then you will do next one. So each time is watching, you can see the bar, right? So you can see money drop, money growth rate, right? Change it to lower and lower. You see one lower, then we're in a recession, right? When it's going up again, then this period, then going back again, going lower, recession. After recession, go jump, okay, and go back, a recession. Why we do that? We want to see whether money and the recession have a relationship. If we find a relationship, a very good one, then we can make a conclusion. We can say, you know what? Whenever the money going down means money growth rate dropped, we'll go to recession. So then we don't drop the money growth, we'll be okay. We will never go to recession. How nice, right? So that'll be solve the problem. Means we don't have issue anymore. But is that so simple? Let's go back looking at, right? So this is money drop, money rate, right? So percentage, if I remember, so percentage means dropped all the way, all right? Percentage wise, dropped, so recession, good. And this is really annoying, right? So basically now the drop, now up is flat, okay? And then it's going down. And then you see here, becoming problem. Is going up. So we must be learn from past to say, okay, you know what, if we go to recession, we put the money, will be no recession. But actually see, look, we put the money in, increase a lot. We're still in a recession. This is the before 2008, right? And this is recession with 2008. You see, this is the same thing. Even if we're in recession, we give a lot of money, we're still in a recession. So now you don't see 2020 to 2019, this one, we are put right now, exactly right now you see, let me tell this. Remember 2008 here, we put a lot of money, we print a lot of money, global print a lot of money in here. We try to out of the recession, right? But you know what? We put all those money recession. Right now, we in this 1 year, we put 3 times of that money. Can you believe it? So that means we have a lot here, okay? So here's conclusion, no conclusion. Conclusion is no conclusion. Why? Because this is money going up, we still go to recession. But this is not, this going down recession. So that means that's not easy task now. Means money is important, but now money cannot clearly tell you how to get out the recession or don't get in recession at all, okay? Okay, so somebody asked me a question. So money two, what are you trying to ask me? Okay, money two, say it. So low post 2008, but Fed balance sheet has increased. Yeah, since then, yes. Fed balance sheet during 2008 increased a lot. Before maybe less, I remember before the 2008 financial crisis, Fed balance sheet less than 1 trillion. I think it's 980 some billion, okay? Then we becoming 4 trillion, all the way end to 2008, 4 trillion. Then after that, then we slowly try to reduce this Fed balance sheet. You know, you will learn what it means Fed balance sheet. Fed just like our personal account, right? Just have balance sheet there. But then the Fed balance sheet jump all the way 4 trillion. It's too much, we borrow. So it means we print a lot of money. We worry if something really wrong, we cannot print anymore, that'd be trouble. So that means we better reduce. So reduce a little bit, okay? Not that much, we didn't reduce that fast, but then we have this pandemic. So now we don't care. We just do whatever it is we want to survive this 100 years at times of this pandemic. So that's why we just do that. But however, everybody worry about this possible inflation. One, they're going to be, we not see yet. Okay, let me mention this again. People ask me the question. Here's the inflation story. You will learn more. We want to have a little bit of inflation. We don't have okay? We want to have a little bit like under 2% or around 2%, the Fed feel comfortable and everybody feel it's okay, 2%. But like we say, if it should jump at a super hyper inflation, and then will be a problem. But then the Fed, we learned that. Remember we talked about oil that moment. Since that oil crisis, we learn how to fight inflation. So that means we won't go there. We will immediately do all the possible tools like increase interest rates, do a lot, reduce money supply, everything, and make this calm down. Okay, so they will do that. Okay, so that's what they know. They learn how to do it. So that's why they don't afraid have some inflation. We want to have some. We don't want to go to deflation. So we want to go to a little bit high, little inflation. It means around 2%. That's the point. Okay, but it's not easy to target. So we'll see. But we're not there yet. We don't worry today, but we could worry tomorrow. Okay, that's the inflation. So let's see this one. Okay, so you can see the red one, money supply, money tool, right? You see, I want you to tell me though. See, again, let's go back training yourself. Once you generate the reports, this data, whole world see the same data. You generate a chart, give it to your boss, right? Give your manager, and then your manager will ask you a question. Okay, you print out, you created a chart. Tell me what the chart mean and what the conclusion. So they don't want, like the manager, they're too busy. They just want you to tell them. And then he will judge it. And if you make it wrong, you get trouble. You cannot get a promotion, right? So that's why training yourself, how you report this chart. What do you summary? What do you see? Take my class opportunity, training yourself. You go anywhere you can talk, can explaining. That's very important, right? So let's see what you can do.
So
okay. Go ahead.
It seems that around 1995, the aggregate price level sort of decoupled from the M2 money supply.
I like that word, decouple. Very good. Yes, very important. Very good. Continue. Yeah, they decoupled. Now continue. Still can say something. Then what they tell you? So
we are not. Oh, yeah, sorry. So that we are not seeing as much inflation as compared to the money supply as before. So despite money supply still growing steadily, it's not causing the aggregate price level to rise.
Right. So then what do you tell your boss? Say, should we continue to the increase the money or not? So can we go further? You do a good job. You did a very good job. So you're too good. I have to push you a little more. Go ahead.
I think that this would mean that people in general are not spending as much money as they did.
You already see people. Remember, those are money too. Government put the money in the system. Okay, just say government is people. Okay, so yes, okay. Okay, so let me go ahead. I just want to push you guys thinking more. Good, very good, okay? Continue. Okay. Yeah, but this is 2000. Yes, this is 1950 to 2011. Okay, so here's let's say is you interpret chart. You guys doing a very good job, but let me help you a little bit. Key point is you both want to see say the chart tell you what. So one red is money too. Means money supply keep going up. That's what we are human being do it. That means our Fed, okay, our government official make a decision, say, okay, put the money in. The more the better, right? Why the more the better? Look at this. The blue line is GDP deflator. What do you mean GDP deflator? It's just GDP, but however, already consider inflation adjustment. That's what I mean, okay? So I will show you what the GDP deflator, how to calculate it very soon. But just let me talk about this interpretation, okay? So blue line is GDP, okay, after inflation adjustment. So that means before 1995, like he said, okay? See, look, they're moving together. That means what? We put more money supply, we will have more GDP after adjustment inflation. Isn't that nice? If the chart always before this left side, that means we remember GDP just like your income. It's our country income. Okay, very important thing, right? We all every year we measure is GDP. So GDP is so important. Okay, so the higher GDP, the better. So then this left side tell us say, okay, our money supply can help our higher GDP. Okay, put more money in, then we get more GDP. How nice, right? And that's why he say decouple. That's very important, that word actually, very good. So that after 1995, look, it's not true. We put a lot of money, we thought we right, and we put a lot of money in the economic system. Our GDP after just inflation didn't go in with it, didn't go this way. Okay, so means we misleading, okay? We misled by this before the chart. So then we put a lot of money in the economic system. Actually, we didn't benefit that much, same proportion of GDP. That's really not good. Means we created so much money, didn't get a reward, okay? So let me go to the deflator things. So, you know, just an idea, just to give you some, because the economists use a measure which do not have this kind of inflation. So that's why they use GDP deflator. Let me give example, put it here, okay? So for example, let's say hypothetical, okay? So GDP in 2000, I'm just do this one, 2013, that year, our GDP is, I want to ask you, okay, before I go further, do you know right now, 2020, forget it, don't count it as 2020, 2019, before pandemic. Do you know our annual GDP is? Just give me rough number, do you know? Give me some
20 trillion.
How many trillion?
20 trillion.
Thank you, yes, very good, yes. So we're pretty good, okay? Before pandemic, we have a 20 trillion. But here, let me give you, so 2013 is, so 20 trillion is pretty good, okay? We're a very big economy, okay? So that's at GDP 2013, that moment, our GDP is 10 trillion, okay? And then we say, well, the GDP 2005, let me give you, put in here, 205 equal to 9 trillion. 9 trillion, okay? So here's the case, okay? So this 2005, this moment is real, okay? So real GDP, right, GDP. So how we calculate GDP deflator, I'm just typing here, then you just know how they adjust it. The GDP, I just use it this way. Deflator, so that equal to what? 10 trillion, remember that one, 10 trillion, I don't do it, divide by 9 trillion. So that's equal to 1.11. So you just saw the chart is this number 1.11, and next year is another number. So this is basically adjusted based on base years 2005 real GDP as a base. So you choose 1 year as base, then you based on that year's real money, real GDP, right? Real dollar, that's what called real, means don't count as inflation. So then based on that, you can see how our GDP already compared with the base year, okay? So that's, you understand that what it mean about the deflator, just inflation adjustment already based on certain rule. Okay, this one based on 2005. But however, that's not what we care. We care is about this pattern, okay? Give us some suggestions, say, it's not always increase money supply is going to create the higher GDP. That's the conclusion. So you tell your boss, will say, decoupled. That's what he said. That's a very good word. Like I said, it is in certain years pretty good. Before it's good, but later on it's not. So we cannot 100 based on this conclusion say money supply increase will increase the GDP, adjust the inflation already. It did not work. Okay, it not work. That's why it's not easy solution. Okay, so data showing you. All right, so that's good. So that means we know what's the problem. We know it's not easy task. From left to right, so many charts prove that money supply is not 100% with your GDP growth, okay? So now, okay, look at this one. This too small, give you a bigger one. I want you to do the same logical conclusion, very, very important conclusion I want you to give to me, okay? Hold on. Did you see my chart? I hope I changed my screen. I did it, right?
No, we still see the GDP deflator.
Really? All right, thank you. Let me have something change back. Okay, this is here, that's important. All right. So then you didn't see the chart. Oh, I didn't change it back in that moment. Okay, good. It's fine here. All right, so this important part is important because this one don't have ambiguity. So you can see clearly about what's going on, okay? So left side is inflation, average inflation rate, okay? So you can see my mouse moving here. So this inflation rate, okay? Going up higher and higher inflation. And the bottom here is the money growth rate. Remember I said money growth means keep changing, right? So last year compared to previous year, how many percentage change? Okay, so then go to the right direction, is going upward change. Okay, money means increase money supply, go to the right word, okay, right side. And go to the top, it is inflation. Okay, so all those data is a country. You can see, first of all, I want you to observe, then tell me the relationship. So relationship means what's the money growth rate versus inflation?
A positive
so generally,
relationship.
Sorry, go ahead.
Go ahead.
It's a positive relationship.
Okay, very good. It's a positive relationship. It is, okay. Okay, that's good. You answered that. What about which country you can choose to say, you know, about inflation? It is high, that country over the past. Okay, so that's Turkey, right? You can see there. Okay, let me point this. Very good. Okay, it's true. The trend. Okay, see my mouse. If you do the linear regression, you see the mouse. You see this. This is a trend. Okay, all the data prove this direction. This is called trend. So what that mean? Okay, that means the country who bring to the economy increase money supply. Okay, increase money supply change. This is growth rate, right? So increase it, and the inflation will going up. So if that's the trend, see, this is all the country data prove it. So that means that's to Turkey. Okay, Turkey like that. Turkey is in the higher money growth rate and also high inflation. So that means it is proof, the data prove that the country who print a lot of money will have a higher inflation. Okay, let's continue go. Let's looking at the US. United States here, we are here. Okay, we're pretty good. So you can see we are lower money growth and this lower inflation. Okay, so this is why that's showing the trend. But remember, this is old data, very old. Okay, we are right now, we don't have inflation, but we print a lot of time, a lot of money. But eventually, whole point we're hoping. Let me tell you this again. We're hoping we don't have inflation because we think when we're out, we can generate GDP and productivity increase from technology, bigger corporation. We maybe not get inflation because we're hoping we will have that scenario, which is have a good GDP increase, the productivity increase, then we're okay. If we don't have a good GDP after printing those money, remember I said you just answered GDP have 20 trillion. We print right now, let's say we just give everybody say 1.9 trillion, right? So it's not a big deal compared to 20 trillion. Plus we in this one of the 100 years problem. But if we don't have a GDP increase and also productivity increase, we maybe end up in trouble. Only you just saw that chart, GDP and the money supply, that red and the blue chart, you saw that. If that didn't happen, we will trouble. So now we're hoping we can handle it. Okay, so let me get back. Okay. So this chart is clear, showing you money. This is not an ambiguity. Okay, it's not. This one showing clearly say money growth will bring the inflation. Okay, but like I say, then you will say, okay, the professor, now you know we're going to have inflation because we increase a lot of money supply. And I just give you a hint. I say, if our GDP and productivity increase, we not end up that way. Because we are a huge country, $20 trillion GDP level. So we can easily catch up if we're doing well. So we're gambling there, but we're dying now anyway. So that's what we're doing. Say, why not? Why we don't survive first? And then we deal with this inflation. And hopefully everybody have job. Then with GDP immediately going up and production going well. So that's what we're doing, okay? So money and interest rate. So interest rate, we mentioned that is a cost of borrowing, also is a saving for your money, right? So interest rate very, very important. You remember we put the money, immediately people will figure out, let's say inflation gonna come in. That means pricing in the interest rate, okay? Interest rate inside have inflation. We'll learn that as well, okay? Just to tell you the relationship, okay? So not trying to tell you in the past what happened. This is mentioned about the chart. Okay, let's just don't mention this. We just go to chart right away, and you're going to make a decision again about this chart. Okay, so here's another thing, right? You can see relationship, interest rate versus money growth rate. Again, money growth rate, remember the change of the money year over year, that's the percentage change is growth rate, okay? It's the blue one. And the red one is interest rate. Remember, we have many interest rate, okay? We here just mention about this interest rate is on average. Here, give you an example. Interest rate is one long-term treasury bonds, okay? So they didn't tell exactly how long the long-term, right? But it could be 10 years, could it be 20 years, but it's long-term government bond, okay? So that means normally this yield will be a little higher than 3 months yield, okay? But you just know interest rate versus the money growth give you an example. So you can see that, like I say, observe this chart and see what you can see. And then what a points find out relationship. Because when you do the chart, I always tell you the relationship. Can you find one? Or do they have one? And then if you have one, how? Okay, anybody? Do you have some observation?
I would say that until about 1980, 1985, the interest rate and the money growth rate were had a negative relationship, so they were opposite. When one goes up, the other goes down. But after 1985, the interest rate has been steadily decreasing, and the money growth rate has kind of been all over the place.
Okay, very good. So conclusive, right? Cannot conclusion. We cannot make a conclusion, right? We cannot say, okay, hey, Fed doing this, put the money, increase it, the interest will go with you. Or you can see this, it cannot make a conclusion, say one way or another. Like he says, later on, it's not that way. Okay, let me show you here. Very good, okay. See, look, the blue one is money growth. Of course, money growth changing up, down. So you can see that the when the money increased, so what happens? So this is even tiny, but still lower. So increase money, okay, means money growth, okay, means change, increase it. So actually interest is going lower, okay? So more money and lower interest rate, okay, good. So the upside, and this also relative upside, when we put a lot of money in the system and interest is low, and then going higher again, put a lot of money and interest rate, well, going up, right? So that means not that exactly going down upward. So this was upward, okay? So when we drop the money growth, so we don't put the money, we reduce the money growth, actually interest going up, upside. So this is upside. So there are many upside, like he's right. After this 1985, remember 1985 is a crazy moment, right? And then after this, you can see still up and then 85, remember 85? So, okay, after that, look. So then interest is going up, this may be flat and then going down. So that means still relative going to that direction like before, but flat a little bit. But later on, you can see same direction. So means what? When we reduce the money supply, what we learned before is that money reduced, then the interest will going up, but actually this is same direction now. Okay, so that's becoming confusing here. Okay, let's see other. So this is one upside, this upside. So that's okay. So let's go to past pattern, like he said, all over the place, right? One moment this is together, and one moment the upside. So this upside, okay? So what I mean? That means we have no conclusion here. Means nothing clear picture say we do one way of the money supply and the interest rate will follow as what we expect. In no such thing, okay? We do not have a clear conclusion. So same thing again, the Fed say, okay, we have to, that's why Fed say, we from learning from the data, and then they call data frequency, right? High frequency data, and then showing us what it's going to be. Then we're data dependent. That's the whole point. Why data dependent? Because we don't have a trending. We don't have a direct, not simple 1 + 1 = 2 cannot make that conclusion. And that's why it's difficult, the job. That's why I say they need armies of the PhDs to do the job. Not easy, okay? So somebody asked me that here's inflation 2%. Here's the case, okay, let me say it again. The inflation not 2% yet, okay, we want to. And like I said, armies of PhDs, economists, they did the research, they feel 2% is comfortable range of the inflation, all right? But we're not there yet, but that's what they target on too. Can be 2.5 is okay, that's what they want to. So say 2.5, don't be panicking, will be okay. And 1.5 is okay, but we're shooting on target as 2%. That's what they want to do, okay? So anyway, so now you know, no clear picture about how to take make the decision about money supply to affect interest rate, affect recession, nothing clear, right? So we know that now. So this is chapter 1. That's why we needed to learn deeper. So this is just tell you something not easy to do. We need to learn more, right? So here giving you, you learned this before, you know, fiscal policy versus the monetary policy, okay? Somebody tell me what the fiscal policy do. You learn macro 101, 102, micro, both of you learn, you know that. What's the fiscal policy do? Give me example.
Fiscal policy is kind of like related to the stimulus that the government is deciding on right now.
Yes.
It's how the government handles their money.
Yes. Continue. Somebody else can make more. So yeah, I know you're right. So
tax cuts can also be a part of fiscal policy.
Yes. Yeah, increase tax, also fiscal policy, okay? Where the money coming from? Where our money coming from? Where the money paying, let's say, our military, our defense, where the money coming from?
Taxes?
Yeah, taxes, right? Okay. So let's satisfy. Fiscal policy is government make the policy say how much, like we're going to be, promise to you, we're going to increase the tax. Why I promise to you? Because this is going to happen. This is going to be true now. So tax will be increased. You think we get a 1.9 trillion? It's a good deal. It's a good thing. Very soon you will see tax will increase by that way. Okay, so that's the policy. Is the government that make decision. That's a fiscal policy. Tax you. Okay, they use money to pay those bill and also borrow money. Yes, issue the government debt. Also borrow money because of a deficit, right? So borrow money spending. So that's a fiscal policy. What they're doing. This course not to cover fiscal policy, what they do. That's the government policy. You can learn political science, whatever, do that. This course is focused only monetary policy. It's also government, but different. Okay, this is total another government official, but not use fiscal policy tools. They use money supply tools, just only handle money. Okay, like they talk to Treasury Department, say, how we're going to conduct the money supply. Okay, but the government make decisions that should put more money in economic, less in the economic system. They have to pass from Congress, make a decision, make a vote, and then decide to say, okay, 1.9 trillion. Remember you saw them, 1.9 trillion takes so long. You haven't received it yet because haven't printed yet. Okay. So that's how this is what they're doing is a fiscal policy. Monetary policy is different. Monetary policy, it is the Fed conduct research and then they ask the treasurer, say, the congressman agree, so we should be provide money supply, how much $1 million in the system, and they conducted business to do that. We'll talk about detail about how monetary policy to do that. So they can do research about like what the interest rate level is, employment level is, inflation level is, and then so then they can get the permissions and how much money to put in. They have to get a permission to print money, not just they want to. Okay, so that's a lot of things, but that's different. Okay, fiscal policy, like we say, how government spending on the defense, how tax increase, all that, those things are fiscal policy, and we don't talk about that. Okay, so now we come out of Fed. So see here, I said the Fed. I maybe say too fast. You got to stop me. Okay, always ask me a question. You can stop me because I do not know something. I think you already know, or something maybe I said too fast. For example, the Fed. The Fed is a central bank. Okay, the Federal Reserve Bank. Okay, also people call this is a system. It's a big, you will learn that. Federal Reserve banks have a lot of banks. Okay, it is under each district. We will talk about that, but that's why I call Federal Reserve Bank system. And then we just use simple word called the Fed. Okay, our U.S. central bank is the Federal Reserve Bank. We call the Fed. Each country have their own central bank. They make a monetary policy, and that's what their country, like Japanese, Europe, they all have their own central bank. Okay, we have ours. So that's what we refer to. Central bank, the Federal Reserve Bank, make a monetary policy, and they conduct it. Okay, that means they make a decision. They do research. Remember, they research. They say interest rate should be, let's say, 2%. And then they put the money in the system to adjust it to be 2%. They can do that way. That's what they do. Okay, that's monetary policy doing. Okay, so now we know this one. So now they touch the deficit of fiscal policy. Now you can see. Okay, the chart is old, right? So 2010. So now it's 2021. So 10 years short. But obviously, we're now in the surplus. Okay, so blue one is a surplus. Okay, now see our deficit. And so where the deficit money coming from? Deficit means surplus means we have actual money, right? Deficit means that we borrow the money. So do you know where we borrow from?
The bank?
China?
Bank?
Yeah, China. Yeah, no. This is within the country to another country. Remember, our U.S. Borrow money. You borrow, maybe our U.S. borrow money from you and me, means you buy the treasury bond, I buy treasury bond, but you and me very small. We don't even moving the price at all. Okay, so the country China and Japan, okay, is the number 1 or 2 lending money to us. Okay, so now you need to know a little bit because you're too young. You shouldn't know these things because this is borrowed money, actually borrowed from you, your generation, because this generation, our generation, basically just spend the money and then all the debt leave to you. You're going to be working very hard to pay back debts. Why you have to do that? Because imagine China and Japan, they lend the money to you. One day they wake up and they say, you know what? They already did it right now. They don't want lending to you that much anymore. Means you borrow money, spending lavishly, buy the super 2 cars, 3 house, whatever. That's what the American life, right? But the problem is, if one day they don't want lending to us, because how we doing that? You know that you will learn more. We rolling. What do you mean we rolling? Means we have, let's say we borrow 10 years, we issue 10-year treasury bond, for example. But when 10 years expired, then we issue again to renew it, issue again. That's called rolling. Okay, this one expired, then we issue again, keep rolling it. So one day when we rolling, the China say, I don't want to lending to you anymore. Then we cannot borrow. Let's say it's 100 million. We cannot borrow 100 million. This 100 million, we have debt. What are we going to do? We have to starve, means let's say trillions. Trying to lend us trillions. So what that mean though? That means if one day nobody lending to us, we cannot even rolling the debts, then we got a trouble. Also, one more hint to you. Even we increase interest rate, remember we said we're allowed to increase 2%. Even we go to 2%, you guys after the class looking at the balance sheet, data balance sheet, the size, then calculate it. If we increase, let's say maximum is 2%, then you tell me how much interest we pay Japan and China each year. How much money? Very quickly, you're going to pay all our GDP. Remember, you said $20 trillion. So we made a GDP a year. Maybe very soon, I don't know when, but in your lifetime, maybe like that, if interest is going up, you're going to become all you generated GDP, become and pay the interest of your debts. That's why we're fighting on this money printing. Should we print it or not print it? You know, that's the problem. That's a lot of problem. Now you see this deficit, you should be panicked because what happened is right now worse. You see my mouse right now, 2021 of the pandemic, we are all the way down. We're even worse now. Yesterday, I think they reported saying with this pandemic, borrow money, the debts, print money, 3 times more of 2008. Remember, 2008 last many years. Then we do a lot of money rescue out of this period. But that's over the years. This is just 1 year. So that's why it is scary of the money we print. That's why so many people worry. So now we do not know what's going to happen. Right now, even economists are fighting, have 2 groups fighting to each other about whether we should give this money or not. So a lot of argument, okay? So now you understand the deficit, it is here and still there, okay, bigger. Foreign market, we mentioned about foreign market, how big it is, right? So I mentioned it already. I said $4 trillion daily. Foreign exchange market is trading almost 24/7, right? So it means when you sleep, they are European and Asia still trading. So the market never sleep, very big, okay? So the price is in the foreign exchange market. Of course, it's the exchange rate, right? You go to Paris, you go to Europe, you have to convert a dollar, and so you can spend the money. Right now, it's relatively easy. Technology making everything easy. Before you just use the credit card, you go to Paris, you just buy whatever you want to buy. Immediately, they convert it to local, that moment exchange rate price is good. Right now, even better, use a smartphone. you can immediately know what's going on. So foreign trading market, but it's big, very active, okay? So exchange rate, now they tell you, this is a basket, okay? How you measure our dollar. So our dollar versus a basket of key currency. For example, inside maybe have Japanese yuan, Chinese yuan, euro, those are all together in a basket. And then you just measure this basket value on average versus our dollar average. Then you can see the movement, okay? And so in general, it's very calm in normally, but if something happens, you can see it's a little bit dollar strong and weak. You can see the problem. See, this is always this period, right? So this is the, remember, oil crisis moment, and the cost of dollars a bigger issue there, right? So that's another way. So otherwise, you just know, if you don't go to travel, don't go global, don't go to exchange market, you don't worry about the currency ratio at all, exchange rate at all. But if you do international business, for example, Apple have companies in overseas, then you need to pay tax, then you had to pay US dollar tax, then you had to convert it. So then if that moment, if a dollar is too weak or too strong, either way, you could feel hurt or not hurt to you. That's what the global corporation or bank always concerned about the currency movement. Otherwise, we don't need to worry, okay? So international financial system. So of course, if you understand our financial system, you're very good enough, okay? But the international, same thing, because we go to global, we have to understand the international, but they seem similar to us because we normally is the leader. Normally our financial system very dynamic. We make a lot of mistakes, but we adjust ourselves and getting better, always also very fast. You see, we out of the recession, the 2008, the first one, get out. We first get in, right? We first to have trouble, but we get out also first one. We do everything possible, get out, okay? So we are the leading on all the action, and then later on they follow us because we do the things works. Okay, so that means, so we most system working it together and they look like similar. So it means you can understand here, you can understand the international, okay? But here I want to ask you about this important one, okay? IMF. Is anybody familiar and what they do? That's very important. Maybe you end up get a job there.
The IMF is the International Monetary Fund. They lend money to countries that are distressed, financially distressed. So like Jamaica, for example, back in the day, they lend to countries that are in bad financial conditions, basically. Yes,
very good. Yeah. Okay. Just imagine, right? Globally, you have rich country, you can poor country, you have trouble. Like in the past, I think I have just like financial crisis that moment, 2008, that moment, have a lot of country, they all follow with us crash, financial crisis, okay? And many countries have debt problem, like Argentina, Italy, Spain, they call pig or whatever. It is a problem, okay? So then, if without the IMF, okay, then we will be trouble. Means how we pay out those countries. You don't want those countries get trouble. So what happens is that's why global set up this IMF, okay, International Monetary Fund. That's good. It's a fund, okay, it's money. It's a global rich country put money in the IMF. Then those money will be help those countries who get in trouble. For example, they give money to Spain, Italy, Argentina, lending them money, loan, okay, like a loan, sometimes forgiven loan. Sometimes the loan to punish them, you have to pay high interest. But no matter what, it help them survive. But the problem is give them money and then they feel, okay, you know what, IMF always there. So they just don't working hard to come back to their fate. So that's the problem. But however, IMF is there, help the country who have trouble, which is a good thing in general, is helping, if a country have a problem, what are you going to do? You have to somebody help them. So that's what the purpose. It's important, okay? And working at IMF is a good thing. because they do the economic research, they figure out which country need the money, why they need the money, and they set up the policy. It's a fun part. It's international. It's a good thing. Okay, so that's what that's last resort. A country need help is go to the IMF, and that's another thing country knows. Okay, that's good. So banking, financial market. It's very, very important, not just money. Money is very, very important. Like you see this pandemic and 2008, always money come in to do something, help out. But work and not work, we will see later. But at least each time this trouble will go there, okay? But not only money, okay, banking. You imagine you will learn more about this. Money not go through, so we go to the sky, use a helicopter, dropper. It's go to bank, and the banking starting to distribute this money, and how they do that, we're going to learn that. Okay, very, very, very good conductions. Okay, and then financial market, very important. Financial market, if like a stock or crash, an interruption, right? It's nothing gonna working well. So we have to have those banks and the financial markets smoothly working. And so that's very good, very important. Sound financial market is important, okay? So here trying to tell you is demand for assets, simplify approach to the demand for assets. Remember assets we refer to, for example, bond and stocks, those are the financial assets, and the land is real assets, right? So we can use the financial market to obtain those assets or to selling assets. Without this market, you cannot do it, okay? And then, of course, you learn economics, you always have balance, means equilibrium, demand and supply, equilibrium. Same thing for the money supply, have equilibrium, okay? So that's why when we talk about money supply, we also have to talk about money demand. So then we will talk about detail about those pieces, okay? So here trying to say behavior in financial market. So basic supply, demand, to explain behavior. Remember, financial market is really human being inside, okay? So that's why market could be oversold, market could be crashed because we human being do not produce anything, do not do anything, and then panic, we always draw money. So a lot of behavior involve human character. So when we do something, we know. So that's a lot of things there, okay? So also the other thing trying to tell you, people, everybody do business searching for profits, right? For the money, for the profit. So when you invest, you want to make money. That's what I mean for profits, okay? So another thing is the financial structure. So this, financial market, financial system, you will see have a structure built up, how the banking, what's banks, what's investment banking, what a difference, right? And then those different kind of structure, like insurance, investment banking, commercial bank, this build up that way, it is very important structure, very important, okay? So that's we understand a little bit more how that works. And then we will learn another thing called asymmetric information in this financial system. It's very, very important because do you know, I want to ask you this question, is Ben Bernanke? Anybody know Ben Bernanke?
Chairman of the Fed in
Yes,
2008?
Previous one, yes, very good. So because he handled the financial crisis 2008, okay? He was chairman of the Federal Reserve Bank, okay? So remember 2008, if you want to look at the video, you can see a lot, right? So they always have a testimony because the chairman must be tell the congressman who wanted to know what's going on to this market, right? So you will know the game store short squeeze is going to be come out of testimony too, I think 2018, but February 18. Same thing, right? So they're going to testimony, give the presentation, what's going on. So Bernanke come out and then give testimony. Then those congressmen wanted to know, say, Bernanke, you're a doctor. He got a PhD on financial recession, depression, 1929. So that means his doctorate degree of the dissertation, it is that paper on the 1929 depression, okay? So that's why he's expert. He's really good man. We choose that moment. So they just wanted to ask him, say, hey, doctor, just give us one word. What happening to financial crisis 2008? What really happened? So he did. He said, okay, I just give you 2 words, which is asymmetric information problem. He said is this. He said all the financial market causing problem is this one, asymmetric information, which is true. Okay, we will learn a lot about this. This asymmetric information caused this financial crisis. So we're going to learn, okay, you're going to learn a lot about this, okay? So then we'll learn about the supply demanding. So that's basically the chapter. So now I'll tell you some, I don't want to mention this piece. That's it, we're done. So this will tell you about the Federal Reserve website. Remember, you can find out the Federal Reserve, all the data. They have a balance sheet, they have history data, unemployment, you know, the money supply, everything, money to all in web page, very open, okay? So that's what this chapter we done. So let me summary about this chapter. It's introduction, okay? Nothing deep, okay? To tell you what you're gonna learn, why this is important. So here's the key, okay? 3 components, right? One is money. When money supply, we're gonna learn, and very, very important, the Fed control money supply, how they do that, you know, the process is there. And then you have financial markets. So basically you have commercial banking, investment banking, and then you're gonna learn those instruments, financial instrument, which means the bond and the stocks, how that works, because once we understand those financial instruments, then you know how they link to money supply. So when money put in economic system, why stock market tank, why stock market going up, and why bond market is squeezed. So all doing well, all is linked to this Fed decision. So therefore, we have to talk all of them. Then we have to talk about the system, how the banking working with you and the banking working with the Federal Reserve Bank. So these are 3 players, how they play each other in this field. So then we know each thing's decision when they make it, what happened to the economy. Okay, what happened going to be a fact. For example, if you don't learn anything, you already know, okay, Fed print a lot of money. Must be inflation will coming. And my mom said, we're going to buy a house. Should I tell them buy a house now or buy a house later? If you know inflation coming, why buy later? You should buy now, right? So a lot of things link like this way. So it's important to learn this course. Like I said, it's because this course is not narrowed down to each subject. Let's say bond market should be 1 semester, okay? Stock market, stock, or how to value it, how this is the corporate finance and the equity, it should be 1 semester, okay? And also we have 1 chapter is derivative. Derivative should be 1 course, which is 1 semester. So that's why there's so many things in this course, and it just touch a little, so that not deep, but also not easy because they not go to whole semester like timetable. So therefore touch and leave, a little bit not that easy for junior people, for never have market experience. They don't even know what I'm talking about, stock, what I mean, never heard about the bonds. Those people, you have to a little bit focus on reading material, newspapers, follow the news, get some sense. You have to have market sense. But if not, ask question, because we here in this class always have senior student and junior student. So it's not same level. So it's very difficult to measure in the middle ground. I cannot be too fast, I cannot be too slow, because it's too slow, senior people will feel they learn nothing, boring. But if you're too fast, junior people say, I don't even know what's the security. You already talk about the evaluation of the stock, and that'd be too much, okay? So I try to be middle, so I want you ask question, and then I know where you are, and then I know how I gonna be fast or slow, that kind of pace. But that's it. This is chapter 1, we done introduction, not big deal. Then we're going to chapter 1 next time. This time that you're done this piece means you already have one chapter. And homework, like I said, don't have deadline. You manage your own timetable. Remember, stay at home online course is really important. Is I cannot hold your hands. I cannot see your face. I don't know you understand, not understand, happy, not, I don't know anything. All you need as adult, just like learn yourself, manage your time, which time to do what, and then in the class time, follow the class. A lot of questions in the exam will be from the class conversation, and then ask a question. So means, like I said, no dumb question in the classroom. I always welcome you ask question so that I know what's going on and you know what's going on, and also benefit to somebody who never, who shy, do not ask question at all. Okay, so that's it. What, any other question? Okay, so we good? All right.
Yes.
Okay, good. So then,
Yes,
okay, so then we stop here. Then we'll next time we'll go to chapter 2. All right. All right.
All right, Professor. Thank you.
Thank you,
Bye.
Professor.
Thank you, Professor.
Yes. Have a
Thank
good
you.
night. Yes.
Thank you, Professor.
You're welcome. Bye-bye.